Last week, America saw the passage of not one, not two, but three bills in order to bring cryptocurrency into the mainstream, i.e. government regulated. And we have saw the most important one, which I would say is the Genius Act. And I'm going to tell you why that is and why Treasury Secretary Scott Bessent, love him or hate him, might be able to take a victory lap. But first, I want to go ahead and welcome you to Ruben Tech, where we talk about the intersection of tech, politics, and finance. Today, we're going to touch on all three. We're going to be talking about something called stablecoins and the Genius Act. Now, I just love the name of these bills, the Genius Act, the big, beautiful bill. It's just like our leadership knows we're a nation of idiots, and they have to, give these colorful names in order, to everything. I don't know. It's just ridiculous. But anyways, I digress. Let's go ahead. Let's get started. But first, if you haven't already, be sure to hit that like and subscribe button. Oh, and I also want to say, when it comes to stablecoins, if you have no idea what they are, I will explain lightly in the beginning, but I will go into a deeper technical dive later on so that even if you know nothing about it, you'll be able to walk away feeling like you know something. Feel free to skip that if you already know what they are. So the Genius Act is the most important part of this bill. And basically what it's doing is it's looking to regulate the stablecoin industry. Now, the stablecoin industry, in my opinion, has been the most important thing that has actually come out of cryptocurrencies. It's actually true utilization, right, of some resources that produces productivity, i.e. it's a true utility. The rest of Bitcoin, the rest of all these chains, have been little more than stores of value. That's been the only use case that they've been able to hit on or use for scams and such things. Now, there is nothing wrong with the store of value. I mentioned this to all the BTC bros when they said, hey, in 2012, 2013, Bitcoin's going to be money. No, it isn't, because you guys know that the network sucks and it can never handle being money. But then the Winklevoss twins came in and they changed the narrative. They're finance guys and they said Bitcoin's a store of value. All we got to do to make it a store of value is convince everybody else it's a store of value. And look, here we are 10 years later and they have won. Bitcoin is now considered basically a digital gold. It's never looked at. Nobody ever talks about it using it as money anymore. And it's basically just an asset class that you can trade for like any other store of value on the US exchange, any other commodity. Okay. That's neither here or there. When we look at the actually having utility out of blockchain networks, though, what do we have? We don't have NFTs. We saw that go boom and we saw that go down. It doesn't mean that NFTs couldn't be useful in the future, but just that the first implementations of them was not such. However, we have seen the explosion of stablecoins, led by two stablecoins, one from Tether, one from Circle. The names of them are USDT, that's the Tether version, and the one from Circle is USDC. And what these stablecoins do is they say, hey, for every stablecoin, every token that we issue, a stablecoin, we are going to have backed it with $1 or cash equivalent, usually a short-term treasury. However, understand that up until now, we just have the word for it. There has been no regulation, okay? And so, but let's just assume that they're correct. And then what happens is, so when you get this token, it's pegged to the US dollar. So what does that do? It eliminates the fluctuations in the price. Because even think if Bitcoin was actual currency, you could use as currency that the network was capable of handling that. I'd go and I'd get this Pepsi, and maybe during the transaction that I got it, the price of Bitcoin would fluctuate by 10 to 15%. I could come out on the losing end of that or on the winning end of that. Either way, that's not good for business. You need something that is more stable, i.e. stable coins pegged to the US dollar by saying that they have a one-to-one backing. Now, we have seen the stablecoin market explode. I think that right now they're processing around $30 billion a day. Now, in the big scheme of things with the entire world, I imagine that's just a minuscule amount, probably less than 1%. However, $30 billion a day, that adds up. You're talking about something maybe that's approaching $1 trillion a year, and it's growing rapidly. And so the main thing about this is that these coins have been largely unregulated. So when we have Tether issuing its stablecoin, all you can really do is take the word of Tether that they have the backing for this coin. So we don't know if there was an actual bank run on Tether, if they would actually be able to produce the dollars. That's up for grabs right now, whether that's true or not. They say it is. They have done their own audits, and they've done where they've hired someone to come, but there hasn't been anybody like an outside organization not connected to Tether, not being paid by Tether, that has come in and actually audited their reserves. And the stablecoin, the Genius Act, is looking to regulate that. What they're saying is that with that, you will have to prove that you have a one-to-one backing for every stablecoin that you issue that's pegged to the US dollar. And so a short-term equivalent, so it has to be a cash or short-term equivalent, meaning that it can be liquidated into cash extremely quickly. So i.e. US Treasury bonds, short-term ones. You couldn't have long-term ones. So that would be like the 5 to 10 year, anything less than that. And this is where I bring in Scott Bessent, because understand that the US government has had a huge problem, and is that it just loves to spend, spend, spend. And right now, President Trump's big, beautiful bill has been hated on by a lot of people, including Elon Musk, because it's really just a big, beautiful spend. In fact, they increased the debt ceiling by $5 trillion, which is, I believe, the single largest increase of the debt ceiling by over $4 trillion, just to put that into perspective. It's really, second place isn't even close. Okay, so the government, we know that the US government is going to be issuing much more debt in the years to come, but they're starting to face issues. And one of the main issues is that the rest of the world is starting to get wary of buying our debt. We've seen this with China in particular. Okay, so in 2013, I believe China held close to $1.35 to $1.4 trillion in US dollars, short-term treasuries and long-term treasuries. So basically in cash. And since then, they have reduced it by about $550 billion, which means they are net sellers by quite a bit. And we've seen the rest of the world kind of follow suit. Not every country. Europe still has a lot of countries that are net buyers, but a lot of other countries are being net sellers. And one of the contributing factors to this is the US's weaponization of the dollars. That is, through the SWIFT system, they have been going out and they have been punishing people. So imagine that you have dollars in the system, right? You can risk being treated like Russia and have America just seize your assets right out of the system. Okay, this is not a good thing if you're a foreign national, and this also isn't good though for the US if we want to sell treasuries, because people are going to look at that and say, why do I want to buy your treasuries if on a whim you can go ahead and just take them right back from me? Okay, right? It doesn't make sense. So we have seen the interest rates on these treasuries start to go up, and they have stubbornly stayed like such. And this has been a goal of Scott Bessent, is to reduce what we pay on our debt, i.e. the interest we pay to the people who buy our treasuries. He's been trying to engineer this for quite some time. However, he hasn't been successful. And this is also why President Donald J. Trump is so fed up with Jerome Powell, because Trump would love to see these rates come down to an astonishing and ridiculous 1%. Now, if that happened, of course, inflation would just, right? There would be so much money issued into the system, it would just blow up. I mean, I don't know. Trump, I don't think he thinks of these things, or maybe he does, or maybe he doesn't even care. As we've said, and when we talked about the great melt up, he might not even care. He might want that, but it just would seem mind-boggling that he even suggests that. Now, Bessent hasn't gone that far. He just wants to get the points down by a little bit, because even a little bit on $37 trillion of debt is quite a lot. And understand that even if it comes down, it isn't like all the debt is immediately refinanced. But as of this year, we have $8 to $9 trillion in debt that has to be refinanced, as well as new debt that we are issuing. Keep in mind, again, the big, beautiful bill basically raised the cap by $5 trillion. That's what they're expecting to spend to be issuing out in treasuries over the next 10 years. That's on top of what they already had allocated, okay? And what they already have to refinance, which is tremendous amounts. In fact, America, I believe, pays over $1 trillion in interest every single year. So we are issuing so many of these treasuries onto the system that we don't have that much demand to cover it as we used to, i.e. that forces the rates that we have to pay to go up. And now this is where the Genius Act comes in. And some people have accused it to be financial manipulation. I'm a little bit borderline on that. I can understand that argument, but I do look at it as good regulation for these sectors though too. I'll get back to that more later. But basically, remember that in order to issue in a stable coin and use it in the US, you have to prove that you have one-to-one reserves. And this is a sector that's growing greatly. And Scott Bessent says it could be as large as $3 trillion worth of cash and cash equivalents by 2030 to 2033. Right? So that means that the US debt, who is running out of buyers for its debt, can say, hey, you guys, you're going to start buying up our debt, which is what the US government needs, since all it knows how to do is spend, spend, and spend some more. And this is where a lot of people look at as financial engineering, right? Because if this new buyer that hasn't been out there wasn't, regulated to do this, then the US would have to face a lot of pressure. But the simple fact is that even if it does grow to $3 trillion, that isn't enough. We are growing our debt by guaranteed at least 10 trillion over the term of the Big Beautiful Bill. Now, again, that isn't just a Big Beautiful Bill. That's in addition to what it already was spending, right? So when you say that you already have money going out the door, this is new spending, but just think of that. It takes our debt from like 36, 37 trillion up to 46, 47 trillion by 2035. Just a ginormous amount. So yeah, what it does, I guess, is it just gives you a little bit more breathing room over the next few years, but ultimately a solution has to be come up with. And so you might say, well, why do I think this is a good thing? Well, because these stable coins, I think they are extremely useful. Okay, so if you use Tether, Tether runs on top of other networks like Tron and Solana, extremely fast, low cost, right? And it's effective. And you don't have to worry. Again, you don't have to worry about paying with like native tokens on these blockchains and having that price fluctuation. It's pegged to $1. Okay, but if we're going to use this, we should have some type of regulation that says, yeah, Tether actually has the dollars to back it. Okay. Right? They should actually have that money in case people are like, hey, I need my dollars, and we all run to Tether at the same time. I want to get my dollars. I don't want to hear them saying, oh, shoot, no, we don't have any dollars. Sorry about that. We lied to you. So with this new bill, they'll have to prove that they have one-to-one. And everybody else who comes on the market will have to have one-to-one. Now, there's going to be a lot of chaos in it because all these banks are going to want to issue their own tokens that represent US dollars than any of these corporations can. So just think Amazon could issue its own stable coin, and probably will. Walmart will, Target will, all these different banks will. So we'll have all these different tokens floating around that are acting as stable coins, and it's about to get really confusing and really silly, right? But that is what it is, okay? And it does create a market for the Treasury that Scott Bessent definitely is happy about. Now, don't think he cares about cryptocurrency at all. Scott Bessent cares about the dollar, and this is forestalling the inevitable end of the dollar. Now, if you don't know about stablecoins, I want to talk about them a little bit here. A stablecoin is a coin that is issued typically on top of another blockchain network. If you don't know what a blockchain network is, it's basically just a digital ledger technology based off of blockchain. Okay, so all it is people just go out and they have a ledger, just like if you had a paper ledger, and except for that, instead of using paper, they write everything to a block and they store it on the block. And you have something called the Bitcoin network, which is probably the most famous network that everybody knows of, and that utilizes this blockchain technology. Okay, but the Bitcoin network is not blockchain. It is a type of blockchain technology. There are other types of blockchain technologies, such as Algorand, such as Ethereum, such as Tron, et cetera, et cetera. So Bitcoin itself is just, the Bitcoin network is a network that utilizes DLT technology. Now, on this network, you have some people, or on any other blockchain network, you have people who use the network, they utilize it for payments or whatever. And you also have people who do work. That work could be mining, that work could be signing transactions or verifying transactions, et cetera, et cetera. And for those people who do work, of course, they expect to be paid. And they're paid in the native token of the network. So on the Bitcoin network, what do you think the native token is? Well, it's called Bitcoin, right? Actually, they have a smaller unit of it that they call Satoshis, but we'll just call it Bitcoin for now. On Ethereum, which is probably the second largest network out there, what is its native token? It's called Ether, okay? And so these are the tokens that you hear about probably the most. Those two right there, the most well-known ones, but they're different blockchain networks. However, for each network, they are the native token that's used for these payments. So now what happens is that when you look at something like Ethereum, you could technically sort of do this on Bitcoin too, but really not, because it's not that efficient and it's too costly. But on Ethereum and Tron, some of these other networks, they are looking at having smart contracts and other such things as assets so that you can have more utilization on top of these networks. And so the Ethereum, it has the ability to run smart contracts. And it has a specification it calls the ERC20 that basically defines what an asset is, or a token, okay? And so this is just, think of it as a small program that runs on top of the Ethereum network. And the Ethereum virtual machine just goes ahead and it runs this program and it executes the code. And this code goes, of course, according to the specification. And so you can create other assets on top of the Ethereum network. Now, they're not native to the network. There are chains like Algorand that have other assets besides algos that are native to the chain, and they act just like an Algorand, like an algo. So, but I guess that really doesn't matter to you. So now when you look at these stable coins, what they do is they run on these networks as these secondary type of assets, okay? So when you look at Tether, it's on top of, I believe, Ethereum, Tron, and Solana. It's probably on a few other ones too. And so when they're on that, it is an asset on top of these networks using whatever technologies they have. And at least on Tron and on Solana, I believe Ethereum still has pretty high gas costs. The transaction and the finality would be super fast and super low cost, okay, for these assets. But that's how these stable coins work. And so they also build bridges from one network to the other. So I know it gets all confusing, but just think of it like this, if we were to summarize it. You have blockchain, which is a type of technology. You have different implementations of blockchain networks, i.e. Bitcoin, Ethereum, Algorand, et cetera, et cetera. Each one of these different implementations has its own native token to pay for work. Bitcoin has Bitcoin, Ethereum has Ether, Algorand has algos, okay? Solana has a soul, okay? And on these networks, not all of them, because, well, I mean, in Bitcoin, you could do this too, but again, people don't because it's inefficient. But on most of these networks, you can create additional asset classes. Some of them run on top of the chain. Some of them are native. Don't worry about that. But these asset classes can be called tokens. And these tokens can be traded and, utilized on top of the networks, okay? And that is where these stable coins live. So hopefully that makes some kind of sense to you, right? I hope I did, because I don't want to go too deep into it, but at the same time, I'm hoping you can kind of basically understand. So if I was to pay you with USDT, What would happen is, let's say that you're listing something for sale and you have an account for USDT, right? I could go ahead, I could send you a payment and it would be finalized, and the transaction fees, if we were using something like Solana, would be finalized very quickly, and the transaction fees would be extremely low. And then according to Tether, you could go ahead, you could take this USDT, and for a very small fee, you can convert it back into your fiat currency. Okay? So that's how stablecoins work. The Genius Bill is looking to regulate that market. Now, understand, if you know a little bit about this, you might say, what about Tether and it has a new stable, it's not a coin, but it's pegged to gold. Now, that is one of the new acts that came out last week, one of the other acts. And because gold is a commodity, it would not be covered by the Genius Act, but one of the other acts. Ultimately, it would fall under the umbrella of the SEC. And so these other two acts, I'm not going to get into them too much here, but just think of it like this. Probably in the near future, we're going to be seeing people tokenize businesses, i.e. they'll be like, let's say I want to start a startup, where I'm going to go out and I'm going to buy apartment buildings, right? I don't know. I'm just making something up. I'm going to buy apartment buildings. Well, maybe what I could do is I could form a corporation, but instead of selling stock, or I could form a company, and instead of selling stock, what I'll do is I will sell you a token that represents a fractional share of my business. Now, though, because I'm promising you some type of return, obviously, otherwise you're not going to buy my token, that's going to fall under the domain not of the Genius Act, but of these other acts and of ultimately the SEC. Okay, so hopefully you can understand what I was talking about here today. I'm sorry, I always wonder on these videos, what is the right balance between keeping it simple enough so that people understand, but yet giving enough detail where I'm not keeping it too simple. So if they tell somebody else, they'll be like, that's completely wrong. But hopefully you got an idea of what's going on. And you can also see why Treasury Secretary Scott Bessent might be very happy about this. Obviously, I do think it's a win for him. Is it a solution? Ultimately, no. Okay, the only solution is to get our fiscal house into order in the U.S., have to start focusing internally upon the U.S., maybe actually have to stop funding wars, stop funding Israel. I know that might sound crazy, but that would save a lot of money, right? We have a $1 trillion+ military. Understand that the U.S. government's already been spending $1 trillion+ on the military, but the official budget was significantly less. I believe it was $780 billion last year. They always go over the top of it because they just have new emergency bills they got to pass. Oh, we got to send Israel another $50 billion of missiles. The strike at aid centers and stuff like that. We got to send Ukraine more money to just blow, right? So it ends up being over $1 trillion, but now our official budget for the military is going to be $1 trillion. So what are they going to really spend next year? Probably like $1.2 trillion, right? So the U.S. government has to get these things into order. The Genius Act is not going to save it, okay? That's what I have for you today. It was quite a mouthful. I didn't bring any notes. I was thinking about doing notes, but I know that whenever I read from notes, people are like, man, you're terrible at reading from notes and stuff. So I try to do everything off the top of my head. If you like this, please give it a thumbs up down below. If you didn't like it, please let me know why. All of you out there, have a great day. Take care.